bring in Christopher Whalen. He is Whalen Global Advisors chairman to give us his view on the full U.S. banking picture and why he has one name as an institution that may weather the storm. Chris, always good to speak with you. Before we get to that one name, I want to get your overall take on what's going on in the banking sector, particularly if you look at the price action today. It seems to have stabilized. I just wonder from where you sit, is this a pause in the panic, or do you think we've actually seen the worst, that we're past the hump?
It's kind of a pause, I'd say, Scarlett, for the simple reason that there's two pieces to this. Number one, the Fed had to make cash available to the banks. They did that with all these facilities they put in place. But the more profound problem that the Fed created during quantitative easing is all of these low coupon treasury and mortgage-backed securities that the banks own, and the Fed owns a great deal of this paper as well. It's trading 20 points below par. So over time, as interest rates rise and the cost of funds to the banks goes up, this paper is going to be underwater. You know, the cost of repo today is almost 6% for secure collateral. So you can't finance a Ginnie Mae 2. Unless you're the Fed or the Bank of Japan or somebody like that, there is just no way you can hold that security without losing money. So it's that cash flow problem, Scarlett, that remains to be addressed. And honestly, the only way to fix it is to have the Fed buy all these bonds back at par. Most banks paid 102, 103, 104 for these securities at the time of issue. And you know what I mean? There's no way to fix this. We'd have to run interest rates back down to very low levels to get these securities back to par.
Well, the Fed has given the banks some room right now with its emergency lending facility, and there's a lot of speculation, and Bloomberg has been reporting that government officials are looking to perhaps expand that facility. We don't know the details of how that would work. What does that actually mean in practice? How do you see that shaping up?
Well, the facility is great, but the problem is I still own a security that has very low cash flows. So depending on the price of the facility, I may still be losing money. But at least I can finance the bond at par instead of having them come in and say, no, the haircut is 80 cents. That's not going to help me. But over time, and I mean the next couple of quarters, Scarlett, banks that own this paper are going to have to make a decision. Do they sell it, get their cash back to the extent they can, and reinvest in higher yielding securities? Or do they just sit with it and suffer the cash flow loss? So I'll give you an example. Bank of America. They have $500 billion worth of securities on their book. The average coupon on a mortgage-backed security, all $13 trillion, right, is a 3.
So Chris, are you saying that not all the big banks are as safe as a lot of depositors have made them out to be?
Well, they're not in danger of failure tomorrow, but they're going to have their earnings impaired by these low cash flows. Okay, the average cost of funds in the industry today for the big banks, the top 130 or so, is about 1.5 points, more or less. And it's going to go up rapidly. So if you're sitting there and you own Ginnie Mae 2s, you're going to be underwater within a quarter. This is like the 1980s, Scarlett. We haven't seen an inversion with treasury yields and other benchmarks above the cost of bank deposits since the 1980s.
So it's going to take a lot. It's going to take a lot to unravel this, clearly. So, Chris, I know that you have picked one bank in this space that you see as a winner, and it's a pretty small bank. What is it, and what was your process in coming to the conclusion that this is a good bank to invest in?
Well, what I would say is this. I own the stock. I always let my readers go first, but I bought some this morning. New York Community Bank's an old-fashioned bank, and the only reservation I've had about them over the years, I've written about them many times, was funding. Because they don't bother with securities, they don't bother with financial markets, they lend. They don't get a great price on their loans. And also their cost of funds was high because they were borrowing money in the brokered market. So in December, they bought a bank called Flagstar, which is one of the most interesting wholesale banks in the residential real estate market. It's the 6th largest loan servicer in the United States. So that has bolstered the bank's non-interest income, which is very important for growing institutions. But more recently, they bought these assets from Signature Bank. They assumed $38 billion in deposits, and they also bought some very interesting assets, but not the multifamily, not the rent-stabilized assets that the FDIC still owns, and I think is going to have a very difficult time selling. So overnight, New York Community Bank's going to be able to pay off all of their high-cost funding and basically have almost 100% cover for their loan book with core deposits that they acquired from the FDIC at no
Right.
premium.
So
That's a
some
pretty nice trade.